Welcome to episode 40 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric John.
And I'm Rachel John.
Let's dive in.
So, Eric, last episode we started talking about the burning question that seems to be at everyone's mind. Am I on track? Can I retire?
Right.
And we discussed how the very first thing that we discuss with clients is what is your vision of retirement? And let's talk cash flow.
Yep.
Let's say we've had that conversation. We've really nailed down the cash flow analysis, monthly spending, all of those things.
Yep.
What comes next?
I don't know.
No idea. That makes people really excited to work with you.
Doesn't it?
It does. Inspires so much confidence.
No, I'm kidding. So now we talk about how we're going to set up and then how we're going to withdraw the funds during retirement, right?
Yeah.
So we want to talk about withdrawal strategies that you're comfortable with. We're going to be talking about your risk tolerance, right?
Mhm.
So there are a number of strategies that planners will use to work with clients around withdrawals and which you can use yourself.
Correct.
Dive into those.
I
We
think
good?
that's exactly what we're doing.
All right.
Yeah.
Okay. So
So,
you can try. We talked about offsetting or losing your income stream from your employer, right? When you retire, you no
the
longer get that.
W-2 has
That's kind of
stopped.
the definition of retirement, right? So now we have to figure out where we're going to get the money.
Correct.
We want to talk about whether or not you're more comfortable generating income, right? So if I'm making 60K a year, now I need to generate $60,000 a year. Do I want to actually just buy or invest in vehicles or securities that are going to produce $60,000 a year?
Sure.
And then I just take that 60,000 out as they produce it, right? That's one strategy
Mhm.
is just produce the income,
Now,
take it
again,
out.
correct me if I'm wrong, that strategy requires significant amount of dollars to be generating.
60,000 a year. If
Yes.
we're talking 3%, maybe 2 mil.
Yeah. Right. So you may have been set up for that. Wonderful. That's amazing.
Mhm.
Right. But there are certainly other options.
Correct.
Mhm.
And they all, I mean, they could theoretically, they require differing amounts of principles, and they're going to require different
Exactly.
calculations for your rate of withdrawals and
And
everything else.
applications.
Right. Another one is to rebalance with your withdrawals. And what we mean by that is, so you typically think of rebalancing a portfolio, right? Where you're going to, if stocks appreciate in value, then stocks are going to be overvalued. Let's assume that I wanted 80-20 stock bond split.
Yeah.
And now stocks move up to maybe 85, right? And therefore bonds are down or fixed income is down to 15. Then I sell 5% of my stocks and then I take that money and buy the bonds. Well, what you can do is you can have a withdrawal strategy where you're withdrawing pro rata, right? So like where you're withdrawing to rebalance. So if I'm 85 stocks and 15 bonds, then I can withdraw the 5% stocks. Does that make sense to make
Yeah.
it to even it out or to make
Correct.
it even? Withdraw stocks until essentially they're
Correct.
80-20 again.
So instead of reallocating it to the other one, like instead of
Right.
reallocating it to bonds, I'm
You just keep
reallocating it to my
withdrawing.
pocket.
Yes, exactly.
Yes.
That's exactly right.
Yeah.
Other strategies that planners will use, some are bond ladders, right? So you can actually invest in a bond that's going to mature, and then when it matures, you're going to take that whole money out, and that'll fund your annual spending. So maybe I spend $100,000 a year.
Mhm.
So for the next 5 years, I can ladder my bonds to mature every year and give me 100,000. So all these strategies are going to have pros and cons, and we could talk a little bit about each of them, right? But a lot of it has to do with your risk tolerance, right?
Yeah.
Like as you might imagine, having the bonds that are going to be maturing and paying you, and you're going to live
The
just on the
regular,
money.
yeah.
That's going to be relatively secure.
Mhm.
Okay, it's very conservative. It's also pretty subject to inflation risk more than probably some of the other strategies, right? You're going to have very little to no equity allocation there, and it also requires you to have an extra $500,000 just kind of like ready to be
To be able to throw
yeah.
right into the bonds. Yeah.
Exactly. So I typically think of that one as quite secure. We would mostly steer clients towards like income replacement, right? So it depends. It truly depends on their risk tolerance. There are some clients that they're going to want to be in treasuries, they're going to want to be in tips, or treasury inflation protected
Yeah.
securities. Um, they're good. It's a very heavy risk tolerance. Risk
Sure.
tolerance dependent discussion. But that's a discussion that you're going to want to have. Okay.
So these are some of the things that we would have. Like these are your decisions that are facing you upon retirement to say, like, okay, here are my options, right?
Mhm.
But if we're saying to clients, like, look, income replacement would be our most common advocacy.
Mhm.
Um, let's say that now I'm 10 years out from retirement.
Okay.
Okay. So, what things do I need to do within those 10 years to make that the most ideal situation for me?
So I would personally say that the most fun planning for me is probably during this time
I
period,
agree.
about 5 to 10 years before retirement.
I
Why
agree.
is that? Because there are A, the most decisions to be made,
Yes.
and B, they're the most impactful.
Yeah.
See, they have the most to do with like taxes, right? So you can really set yourself up if you're gaming out down the road, right? So this is really, I would say, where I want to be.
Yeah.
I
And
love it. It's fun.
can I segue that for 2 seconds?
Let's now talk about Roth
So
conversions.
no, no, but
Roth
but
conversions.
hang on, no. But I want to
Roth
segue real
conversions.
quick. So while most people, the thought of talking about tax advantaged anything or the
Force them to
word
the point of
tax,
sleep and
yes, is horrifying and sounds just like they want to swirl a pencil in their eye. Um,
very rude. This is rude.
the amount of enjoyment that Eric gets from talking about tax advantage. I mean, so if in case any listeners out there don't know, he's in the process of finishing out his EA certification. So this studying has been just rampant part of our life, and so he will come in very excited after having done an exam question that had. I don't know anyone. My parents, by the way, both worked.
This is someone who's supposed to like me, by the way.
I do, and I do like math, and both of my parents were owned an accounting business. And yet I still don't think I know anyone who gets as excited about talking about
I view it as
t-
opportunistic for
it
clients. There's a
is.
lot of opportunities that you can take advantage of within
It
the
is.
tax
And I
law.
feel like you get so much enjoy and I love that. We need people like you. So please stay that way. But the amount of enjoyment you get from being able to
It's fun.
essentially see like here are all the options, but to know that there is an optimal one that
Mhm.
you can find and pick, I think is I don't think I've ever seen you so excited. So I wanted to throw that out there that while when
Thank you.
we're
Thanks.
talking tax advantage stuff,
Really, thanks. That was
the average person I do think is kind of like, oh, um, really does get a lot of enjoyment
I
from
am
it. So
uniquely passionate about a disinteresting or an uninteresting topic.
hopefully you do find somebody who is passionate about the thing that is very impactful and yet really hard to get excited about because they'll live in it
All
with you.
right, let's
Okay.
do it.
So
Raw conversions?
10 years, I was gonna say, we're 10 years out. One of the first questions I think that you tend to ask clients is what do you have in your three buckets? And in previous episodes,
Correct.
we talked about our three buckets. Again, those
That's
are
right,
your
right.
tax free, tax deferred, taxable, right?
Wow, got
Okay.
it quickly.
Yeah. And so, typically if we are working with people and we find that they are, and we do tend to see this, that they're very heavily invested in one, maybe two. Typically that tax free bucket is pretty empty.
It's
Those
neglected.
coffers are left
It's very
alone.
sad.
And so we talked in previous episodes about the benefits and importance of having those three, but in these 10 years, we're really looking at that. So
Right.
what
So
you got?
so here's why. Typically, the time, and we said this when we did one of our numerous episodes on Roth conversions.
Every
One
episode.
of the uh, oh, one of the most advantageous times to execute what is called, like, typically referred to as a Roth conversion ladder. It's between the time you retire and the time you start claiming Social Security.
Yeah.
Okay. So what does that mean? That means if I retire at 60, but I'm waiting till 67, let's say, to start taking Social Security,
Mhm.
and then my RMDs aren't going to start until age 73, or in the year 2033, they're gonna move that back again to 75.
Yeah.
So I have a huge amount of time, even if I'm getting Social Security starting at 67, then between 67 and 75, if you're
Correct.
younger, if you're part of the, like, I guess, younger crowd, I don't ever think of myself that way, as like my injury rate would very much disagree. Anyway, sorry. You have a lot of years between 67 and 75
Yeah.
now. We want to level out our tax bracket. And we talked about this in the past, but essentially what we were trying to do is we always really want to, we haven't met an individual, we haven't seen a scenario where you don't want to pay taxes in the 10 or 12%
Mm.
brackets. You always want to fill those brackets and you want to pay as much tax as you can at 10 and 12%. Why is that? Because at some point in time, your RMDs will kick you into a higher bracket.
Yeah.
Essentially, if you have enough money to retire, and it's a lot of it's in tax deferred, which most is because in
Mhm.
America we use 401ks now, right? And that's almost, there are Roth 401ks. We're not going to derail into that, which I just did.
Sure.
But anyway,
Glad you brought it up.
for yeah, 401ks are going to be tax deferred, right? So most of America's money is typically in tax deferred accounts. Okay. When we
Mhm.
take that out, we're going to have taxes on it.
Yep.
What's going to happen when you get to RMD age is they throw it out.
Of
They don't
course.
care
Yep.
if you want to withdraw it. They
Correct.
just spit it out.
And if you're already getting
And it's
Social
on an
Security.
actuarial table. So when you're waiting till 75, it's going to start kicking that out. Okay. It's going to start kicking a decent amount of that money out.
Correct. It's also important, I think, to like
Somewhere around a
the
20th, I
thing
will
is,
say.
the
Of
government
5%.
is going to collect tax on every single dollar.
They're going to get it.
They're
They
every
either
single
get it.
dollar.
Okay. So that's a great point.
Yeah,
They're either going to get it from you on your IRA
correct.
or your children or
Correct.
beneficiaries. Okay.
Exactly.
So maybe you have kids that are doctors and they're high earners. They're making 500K a year. They're in the
Right.
37% bracket.
Right.
So if you're not paying that 10 and 12% when you could, or even 22,
hmm
then they're going to pay 37%,
Yeah.
right? And then be entitled to 63% of your dollars instead of a much higher number.
Correct.
Does that make sense?
And so exactly. So like every single dollar they're going to get taxes on. So if it's in your taxable account, you paid it.
Right.
Right? If it's in your tax deferred, there's a lot of decisions to be made about when are you going to pay it. So
Yep.
if you're choosing not to pay it at the 10 and 12 because you're like, I want to pay less taxes now, they're still going to make you pay it,
Right.
but it's going to be not your decision when, and it's going to be at a 24, 28.
Exactly. It's
You
very
know.
likely to be at a higher bracket. Okay. So then you might be saying to yourself, wait a second, I thought I was following you guys, and you said up at 10 years up until retirement. I thought we were going to be talking about maybe ages 50 to 60 or 55 to 65. And then you started talking about RMD age at 75 and
Yeah.
series of Roth conversions. I thought you said you were going to prepare us for the early retirement years and what happens right after retirement. That's the idea. So if we know that we're going to if we know we're going to engage in a Roth conversion ladder, we know that we need to set ourselves up for that. What does that
Correct.
mean? That means we need to have enough money in our brokerage account to live on, to pay taxes on, right? So that we don't have to rip more money out of the tax deferred and elevate our current marginal tax bracket. Okay.
Correct. Because if I need 10,000 and I pull 10,000 from my tax deferred, I then am paying taxes on it. So the money I have to use is not 10,000 anymore.
That's also true, but you also are increasing your ordinary income by 10K.
Correct. So then everything that I am now going to convert into a Roth, I've moved the needle further, so I have less of a runway.
Exactly.
To convert.
Exactly. So we can math out what if it's likely, and all of this is probabilistic because we can't guarantee market returns, right?
Sure.
Although you could, I mean, correct. You could invest in marginally safer assets. You can invest in like dividend bonds dividend paying stocks where we're relatively likely to know
But
ballpark what they are.
definitely
You can math it out to
you can
get
get
close,
close.
but it's not going to be an exact science,
Sure.
right? But the idea is we can start our preparation, right? Where we know what money we're going to need in our taxable brokerage, and then we know what number we need in our tax deferred, and then we're going to know what number we're going to end up with in our
And
tax
it's not even that you can start it, it's that you have to start it. Like if you want to be able to retire in the most tax advantaged way, it requires more than I'm retiring next year. What can I do?
Right.
And then it requires more than I'm retired now. What can I do? Like it does require a very well thought out process in
Right.
order to be most optimal.
Right. There should be a plan.
Correct.
Okay. There should be a plan is essentially what we're trying to say. And even if you have no interest in your beneficiaries, because we've heard that before from clients, like whatever, they can deal with the taxes. We don't care. We're trying to solve for our tax planning, not for theirs.
Correct.
Fair. That's a fair position to take. You can take whatever position you want, right? It's your money. It's still very likely to be advantageous to you to pay to engage in Roth conversions to fill up the 10 and 12% brackets because your RMDs will eventually put you there anyway. Assuming that unless you're like, well, I'm going to die at 72. Okay, great. Like, yeah, you won.
It's also
I hope that's not true for you.
It's important as well to note that if you are a married couple, that there's a significant amount of thought that goes into when one spouse dies.
Yes. Widower's penalty. Let's talk about that.
Yes.
Right. So that's another tax planning event that we should think about. When your spouse dies, you're going to be able to file married filing jointly in their year of death. You cannot file for qualified surviving spouse, right? Or it used to be like widower.
Right.
Unless you have a dependent,
right.
which you're pretty unlikely to have. Okay. So unless you have a grandkid that you're taking care of at that point or whatever, right? Like it's pretty unlikely to happen. So you're going from married filing jointly to single, which means your standard deduction is halved. Your tax bracket is halved. You are going to be paying significantly more
way up.
taxes.
You're gonna
So
go
if you
way
were
up.
like, well, we're happy in this 12% or 22% or whatever, if you're in the 12 or 22% as married filing jointly, it is very, very likely that in
Mhm.
your year after your death, your surviving spouse is going to be kicked up to the
Correct.
24,
Correct. And so when
which
we're
will become the 28 and everything else, right?
and so these are the things that play into why we're saying it's so important to take advantage of paying at the 10, at the 12,
Right.
even sometimes at the 22, because we know 22 is going to go up to 24,
Correct.
24 is going up to 28.
We're talking real quick. We're talking about the sunset of the Tax Cuts and
Yes.
Jobs Act, which
Yes.
is going to happen December 31st, 2025. So in 2026, she's talking about the fact that the
Correct.
22% bracket becomes
Won't
24,
exist
the
anymore.
24 becomes
Correct.
a 28, etc.
So we know
Unless
that,
Congress acts, which
which
they're so fantastic at doing so,
it's
Anyway,
really, really
go on.
efficient. But between the sunset, between I mean, unless a tragedy befalls you, typically one spouse will outlive the other. So at some point, a married couple is going to go from married filing jointly
Right,
to
just
a
single.
single. And then your RMDs. So you have three huge things that are working against you that will continue to
To,
uptick those
to
brackets.
start not to just try to bump you into higher brackets,
Correct.
right?
Correct. And if
And
you're
even
gonna have
and
to
then
pay
even if you
tax,
even if you both live to 99 and you both go on the same day or whatever,
amazing.
your RMDs will have bumped you up at that point, regardless. But even let's assume they somehow didn't. You still have beneficiaries, presumably, of your accounts, unless you're giving everything to charity, that are going to have to pay the tax bill.
Correct.
Okay, so
The
you're not.
government will get their
They're
slice
going to
of
get the
pie
money.
no
They're
matter
going to get the
what.
tax deferred dollars. They're going to get the
Correct.
tax on the tax deferred dollars.
And so if you're able to make that, and I think it's important, and we talked about it in previous episodes, but one of the huge benefits for that Roth conversion is to pay the tax on your timetable
Not
at
theirs.
your
Exactly
bracket.
correct.
And once you've paid the taxes on it, you're good. Those
We want to have
dollars are
control.
done.
So look,
They're out of their
I also want to say that
hands.
we're talking about Roth conversions because it's the most frequently used tool and it's a tool that pretty much applies to everybody.
Mhm.
There are also things that you might want to engage in, like capital gain harvesting. Essentially, what we're saying is what
Mhm.
that means is you sell something that has a large capital gain on it,
Mhm.
and you can rebuy the same thing the same day. It's not like the wash sale rules that are supposed to prevent tax loss harvesting, tax gain harvesting, right?
Because you're paying money on it.
Right,
They
is when
like it.
if you're in the 12% bracket where you have a 0% capital gains tax or below, if you're in or below the 12% bracket where you have 0% capital gains tax, you can sell the stock, buy it back, and that capital gains is taxed at a 0% rate. So you can do that instead of bumping your ordinary income up to pay
Mhm.
the actual
And
tax
then
of
it will
12%.
change your like if you're rebuying it, then it just changes wherever
Changes your
your basis
basis.
is. Right.
Exactly. So changes your basis.
Exactly.
So the point here is not that you should understand everything that we're saying or
For
whatever.
sure.
The point is that this is the time where you can do some very significant tax planning that can really have an impact.
And it's not even can, it's you should
You
be.
ought to be
Yes.
doing that, particularly, yes. There are, yes, if you're gonna, especially if you're gonna
There's
have
no
a number of
unringing
years
bells,
between,
right?
yeah, before almost, well, not almost everyone, I should say that, but a significant portion of the individuals that are gonna have a lot of dollars in their
Mhm.
brokerage accounts, tax deferred accounts, and they're able to retire early are going to be able to engage in these strategies and really
Correct.
benefit from them. Does that make sense? Like, not
Correct.
everyone's gonna have $1 million in their brokerage and then like 3 million tax deferred or whatever.
Mhm. But if you do,
But if you do, and that's going to enable you to be comfortable with your probabilistic retirement early, right? Or your probabilities that are going to result if you're retiring early, then
mhm,
you're likely to want to engage in this kind of a strategy.
correct. So then these are the things where you have to lay the groundwork prior to retirement, and it can be very complicated, it can be convoluted. I will say that I think that the software that we use and the software that I think the majority of various financial planners use help to take some of these very challenging concepts and provide visuals that really I think help um make the points a bit more salient. It helps to really make very, very clear what runway you have in the 10% or the 12% bracket. So you can kind of narrow down within a pretty narrow window
Right. It helps you
how
quantify
much
some of
money.
the more like
Correct.
broader qualitative discussions that we're
And
having
to
here.
visually be able to see like, okay, if I'm here, like if I don't pay it
Yeah.
here,
Here are the
you can
breakpoints.
visually see
See where it's
where the
going in
next
the
one is.
future.
Correct.
Right.
And
So
you
that's
know,
from a tax perspective, yeah. And then,
correct.
like we talked about at the beginning of the episode with the withdrawal of funds, right? And we're talking about the planning that we're doing there. To circle back to that just a little bit,
Yes.
um, we want to we want to withdraw in a way that's comfortable for you, right? Like so,
Correct.
and your risk tolerance and your risk capacity. Like, how much risk do you need to take? How much
Mhm.
risk are you comfortable taking? And then what kind of withdrawal strategy do we think is going to help you the most,
Yeah.
right? So that's kind of the way you want to think about all of this. You're going to want to think about the tax consequences of your withdrawal strategy, and you're going to want to think of the actual like securities that you should invest in
Yes.
to, so that everything is actually cohesively aligned.
Then the psychological component of like,
Can I
what
sleep
can
at
I
night?
stomach?
Yeah,
Yeah.
yeah, yeah, exactly. Do I need like
Yeah.
really secure, like mature bonds to be funding my lifestyle, or can I live with either funding by dividends, or do I need to actually go,
Correct.
or can I live with just selling the security and hope that it's appreciated in
When
value?
I think that's something that we don't talk about as much as we probably should. It's my favorite part, I honestly, of all of this. I think is
Oh yeah,
it's the fact that at the end of the day, there are certain optimal things and optimal strategies. Um, but if it doesn't fit your lifestyle or your mentality
yes,
and you lose sleep over it,
100%.
then it's not optimal for you. And that's okay. And so there's a lot of work on the front end. Like when we're talking about what does your retirement look like, there's a lot of work on the front end we do with our clients to discuss like what is your risk tolerance? Like what um is your attitude towards the stock market if the stock market dips because we know it's going to. There's a lot of conversation around that. Sometimes there's an educational component because people are like, I have no idea what we're talking about. Um, but at the end of the day, it's really, really important that we make the best decision for the individual that's
Right.
involved.
And I would actually take it just I love that you said that. I would take it even a little bit step further.
Yeah.
J.L. Collins said in his book A Simple Path to Wealth that it's not only like psychologically and emotionally beneficial for you to do things that you're comfortable with,
Mhm.
it actually is financially beneficial because if you are likely to withdraw your funds from the market when it goes down 30%, you would have been better off really just keeping the cash in the mattress,
Yeah.
but keep your
Keep it in
cash
bonds.
in like, yeah, keep it in a money market,
Mhm.
keep it in
Yeah.
like short-term bond funds, something that's less likely to crash
Correct.
like that
Because your behavior is
is
not
negatively going to impact your long-term
exactly
investment results, right? So
correct.
no, that's a fantastic point. Well done.
Thank you.
Well
Thank
said.
you. But I do think that's an important part.
Yeah.
So then we've talked we've talked a lot about setting up pre-retirement. Just to wrap up, I think like now we're in post-retirement. I'm looking to withdraw. Pre-retirement, we talked about the three buckets. I now have things in the three buckets.
Hmm.
Can I just pull money from wherever? Like, does it matter where I pull the money from?
Oh yeah.
So exactly. So I would like you to expound upon like let's say okay I'm now retired, I have money in my tax free account, I have money in my taxable account, I have money in my tax deferred account.
Right.
I know they're going to make me start taking my
Right.
tax deferred eventually. Should I take it before they make me? Should I just be pulling stuff from my brokerage? Should
Right.
I be dipping into my Roth? Like when and how do you envision post retirement? I've set myself up, now what?
We're literally going to math it all out in our tax planning software. We use Holistic Plan. They didn't pay me to say that, but yeah, we use Holistic Plan and we think they're good. And we're
Okay.
going to math out your tax returns. So we're going to say 2024 projected tax return, and then we're going to start putting numbers in there. And then we're going to do 2025 based on
Mhm.
2024's numbers and 2025's projected returns on your investments and that over time, and try to figure out what's actually a viable strategy for you.
Mhm.
And then as tax law changes, we're going to change our projections and our conversion strategies and everything else. The idea is that yes, we're going to withdraw. We're almost always going to fill up the 12% bracket. Sometimes it makes sense to fill up a little higher than that. We're going to be considering things like IRMA brackets. What does that mean? We're going to go into that in a bit, but
Mhm.
and I think some of the next episodes when we
Yeah.
talk more about Medicare and retirement,
Yeah.
right? So we're
That's our
talking,
next one, I
yeah,
think. So we talked
we're
about.
trying to speak to retirees a bit here because that is typically the first. It's the time where most people realize, wait, I don't really know what I'm doing here.
Yeah.
Maybe I should get some help. Some of it, so like it's probably the time where you're going to want to be finding videos, hopefully, so that they can educate you a
It's
bit.
also the time where, like, in one of our previous episodes, we discussed a lot of the various statistics, and the statistics are jarring about how many people have retired and had to either rejoin the workforce
Right.
or take out loans that they know they're not going to be able to pay or declare bankruptcy. Like,
Mhm.
the amount of people that are retired and are woefully unprepared for it is
Right. And
really
these
disturbing.
are very complicated areas.
Correct.
Like I've known some very high net worth
Yeah.
individuals who not have a clue how Medicare
Correct.
works or why they should want to be on
And
it.
there's no great undo button either. So like there's you kind of have your one shot at making the right decisions.
Right.
at various points in
Oh,
time.
yeah, especially when we're talking about Social Security elections, Medicare
Right.
elections, yeah, all that
Roth
stuff matters.
conversions.
All conversions, you
Yes,
cannot unring those bells.
correct.
No, you're absolutely correct. So yeah, that I mean, that's generally it's going to be very situational. It's going to be very unique to your scenario. But
Do you
typically,
have any
what's going to
rules
happen?
of thumb for
Fill the
um,
12% bracket all the time.
but okay, but like, so which ones? So let's say I'm in my first year of retirement. I have money in all three accounts.
Okay.
How should I be envisioning those three accounts? They're
So you
not
should
all
be
created
thinking
equal.
about what your tax deferred account is going to do over time
Okay.
if you just left it.
Right.
The RMDs, what are they going to do to you over time? Let's just assume today's tax brackets for sake of argument,
Yeah.
right? But what is that going to look like? Is it going to bump you from the 22 to
Is
the 24 to the 37?
is there
Do
a
you have a huge tax deferred balance, or
sure?
do you have like 100K? If it's
Is
100K, we're not talking about huge
is
Roth
there like
conversion
a
ladders.
website? Because I know we're also speaking to people who are interested in like DIY, and we talked about how
Hmm.
there's the Social Security website, there's
Yep.
My Retirement. Is there one to kind of calculate what those RMDs are and when they hit, and like
Oh,
essentially
sure.
say what the laddering is for those
Yeah, it's
RMDs?
I think table one of the IRS's website. But
Mhm.
if you look at it, like Fidelity will spell it out for you. Because if you go to the IRS's website, they'll give you table
It's
one, but they'll also give you tables
everything
like two
else.
through 10. And you're gonna have a rough
They
time
give you
because it's
too
gonna be like
much.
single versus married, filing jointly versus surviving spouse. You can Google like what are RMD requirements, and then like, you'll find
They'll
like a
table it for
Fidelity
you. Okay.
website or Smart Asset or whatever is gonna have,
And it's percentage based, correct?
correct. It's actuarial. Well, they're going to give you like a number. They're going to say like divide your total balance by 25, and
Right,
then
right,
like
right, right.
right.
Okay,
So it
yeah,
is
yeah.
percentage based, but
But
they're not calling it percentage based because they don't want
correct.
people to multiply by very small
Um,
numbers.
okay. So you're looking at your RMDs, and I think that the average person's gonna look and be like, okay, cool, but not know what to do with that information.
Got it. Right. So you're going to look at it. You're going to see how high they're going to kick you, right? Like how much the RMB is going to push you there. We need to think about your goals, right? So
Mhm.
Roth conversions also make more sense for people that are planning for beneficiaries. It makes little to no sense if you're planning on giving everything to charity because charities don't pay taxes. So why would you pay taxes so that a charity doesn't have to pay taxes? That makes no sense, right? That's disadvantageous for to you. You're handing money to the government that they weren't going to get otherwise. Um, so
And that the charity was going to get.
exactly,
Yeah.
exactly. So you're actually
Um,
undermining your goals there. But the idea is most people are typically not in that camp. You're gonna want to think about your tax deferred balances. You're gonna want to think about how much you're gonna want to convert. You're gonna want to set yourself up with a like medium to long term tax strategy so that you and your surviving spouse are comfortable with the brackets that you're both gonna be in, right? Like you're gonna maximize the 12. Pretty much always. Like what I mean by maximize the 12 is I mean you're gonna fill it up. You're gonna pay
yeah.
tax and 12% until there's no more until
Until
the
you're
next
kicked into
$1,000 of
the
income you earn would be in the
22. Yeah,
22% bracket or whatever. And then maybe
correct.
even a little bit there so you guarantee that you filled up the 12.
Correct.
Because again, tax brackets are marginal. We've talked about that before.
Correct. So like let's say that I am in my first year of retirement. I need $50,000 to live on
Okay.
for my retirement.
Yep.
Should I take that 50,000 from my brokerage? Should I take it from my tax deferred?
Okay.
Should I take it from my Roth? Should I split it amongst the three?
No, don't split it pro rata. Almost never split it pro rata, like down the middle. That's like kind of nonsense. That's if you don't
You
know what
don't
you're
know what you're
doing and you're
yeah, I was
trying to
gonna
hedge
say,
your
if you
bet.
don't know what you're
You're
doing,
guaranteeing to be. It's kind of like dollar cost
it's
averaging,
definitely not.
but it's actually worse in my mind. But it's basically guaranteeing to be wrong, and you
Yeah,
just have no idea which direction you should be going. So you just go all of the directions. Don't do that. You would think about how much is generated in your brokerage, right? Like, do I have interest income there? Do I have dividend income there? It's gonna be
right.
taxes, capital gain, long-term capital gain. How much tax am I actually generated? And therefore, how much room do I have at the top of the 12%? Right. So if I am married and the 12%, I have up to 94K, okay, in 2024. So I'm pretty happy to if my taxable is generating, let's say 25, right? Or let's round up. So let's say it's 95 was the top of the 12%.
Okay.
Okay. And then my taxable generating what 25.
Okay.
Right. Then I could consider a 70K Roth conversion on top of that. Does that
Got
make
it.
sense? Or alternatively, what's likely to happen is we said we needed 50. Is
Yeah.
that right? We
And we
needed
can need
50.
whatever number if you want to
Okay. No,
adjust
no,
it.
it's cool. So if
Yes.
we need 50, what we're likely to do is we're likely to take some of the income that's generated in our brokerage. Okay.
So we're talking like dividend interest income.
Correct.
Okay.
And then we can take what we need from our tax deferred account.
Okay.
Okay. Like this is assuming we need this money on top of Social Security.
Correct. Correct. This is because exactly that's a great point. So the money that we're looking to generate, if Social Security is giving it to me, I don't need to generate it anymore. So the 50K is after I've discounted Social Security.
Mhm.
Yes.
So if we've got if that's the situation we're in, right? We've got our taxable. We said we're spitting out about 15 that we're going to pay taxes on, but that's 15K dollars that we're actually going to have and be able to spend. That's spendable 15K.
Mm.
Then we're going to want to take money from our tax deferred, such that the after tax
You had said 25 initially, by the way.
what that we were going to take 25 from tax deferred.
Well, you said
Oh,
imagine
I'm
that
sorry.
you had 25 in interest
I
and dividends and stuff. I
apologize.
didn't want to
No,
confuse
no. Okay,
people.
you got it. So 25, we'll
Yeah.
say, is being generated. That's the spendable. So we
So
need
I
to
have 25 more I need to
we need to
generate.
generate another 25 more. We're going to want to pull, let's call it, what, 35 or so K out of the tax deferred so that we have enough to pay the taxes
That's
on
what I was gonna say.
that's generated.
Yeah.
All right. And then we should still have a little bit of extra that we can withdraw and convert to fill up the 95K that we said was the
Right.
12% bracket.
So this is a situation where
In addition to the
even
standard
if I
deduction, by the way.
need, yeah.
So
So
you're
this
going to
is a
have higher than
situation where
94.
even if I need my, like, even if I only need 50, if I'm still married, right? So I haven't been kicked into filing single yet.
Yep.
They're not forcing me to take my RMDs yet because it's my first year of retirement,
Uh-huh.
right? And maybe I haven't even started claiming Social Security. Maybe I have, it doesn't matter. But I have the factors that normally would play against you in kicking up your tax bracket not working against me right now.
Mm-hmm.
So chances are that I still want to be able to realize more income this year than I
Then you
need.
actually need exactly correct.
To
Exactly
be able
right.
to take advantage.
I'm either going to capital gain harvest or I'm going to Roth convert the remainder there. So maybe my whole tax consequence is $60,000. Let's assume that's true, and that covers all my spending needs.
Yeah.
Okay, but we said that the 95 was the top. Right?
Okay.
It's actually going to be the 95 plus your standard deduction because your
Correct.
standard deduction is going to reduce your taxable income. Right?
Correct.
So we would add that, but let's just assume for the sake of argument that it's 95. That's the number we're trying to hit, and we have 60K of taxable income. We want to generate 35K more taxable income.
Correct.
All right, that we
Correct.
want that
Yes.
because we want to pay taxes at 12%, so that we
Yes.
don't later pay taxes at a much higher rate than 20.
Correct. Exactly.
Okay, so that's the game that we're playing right now.
Yep. And so it's certainly
And this planning
something
is
that
fun.
it's his favorite. It really is. And it is it's I think some of the
It's
most
incredibly
rewarding.
impactful, right?
Yes, it's some of the
You
most
can
rewarding
save
because you get to
you're saving that
immediately
10%
yes.
arbitrage, right? Like,
Yes.
so if you're on that 35K, you're
Correct.
immediately saving 10%, 3,500.
Well, and I will say, like, when we're working with younger, like, we enjoy working with and helping everybody. When we're working with a younger crowd, we're doing things where it's really exciting to us because we know what the long-term impact is, but it's not going to be realized
It's
by
not
them
as
for
tangible, right?
years. But to be able to work with the close to retirement, just retired, like groups of individuals is so rewarding because it's immediately felt, immediately realized,
Right.
immediately enjoyed.
And there's usually a more acute kind of,
Oh,
I don't want to say acute anxiety around like these
absolutely.
decisions are really important and they're
Yes.
closing in on me,
It's
and there's a lot of
pressing.
stress,
It
right? So you're
is.
able to alleviate a lot more stress.
Yes.
Because like young people, they just figure we have a lot of years. If I'm
Yes.
30, 35,
Exactly. You
40,
got time.
yeah,
Right,
there's
right,
tons
right.
of time.
Yeah.
I'm saving a decent amount. I'm maxing my 401k. Everything's
Mhm.
going to work out just fine. I'll
Correct.
worry about this problem later. It's
Correct.
not as acute of an issue for them as the kids crying in the other room. You know what I mean? So like they're not particularly concerned.
It's not the most pressing matter. Exactly.
Right. So it does feel good to solve problems for people that
Correct.
perceive them to be like very real problems for them right now.
And this is kind of what's prompted our series, I guess, if you want to call it
Yeah.
that, to discuss retirement issues because of how complex they are, how time sensitive they are, how rewarding it is to address those. So,
That's right.
but yeah, so I'm sure we'll be talking some more about like Medicare and IRMA. I think was what we'll
Yeah.
discuss next.
Let's do it.
So,
All right, guys. So if you enjoyed today's episode, please review the show. And if you have any topics you would like discussed or financial problems you'd like solved, email us at podcast@equilibriumfp.com or reach out to us. I'm sorry, or visit the website at equilibriumfp.com. Wow, that was
way
hard.
too excited to talk about taxes. You forgot how to
That was
speak.
rough.
So next time.
All righty. Thanks, guys.